Good morning, good afternoon, good evening. This is Dr. Dabowski. Welcome to my short instructional video on Chapter 3, Part B, which deals with the accounting cycle and adjusting entries. This is a very important part of the accounting cycle. This primarily deals with learning objectives 4 and 5 in the main textbook. So the accounting cycle. What exactly is the accounting cycle? It is fairly simple, and this is the way I would like you to think of the accounting cycle. Is first, it occurs during the period, and during the period is where we record what we call our daily transactions. And then at the end of the period, we are required under the accounting rules to prepare or to record our adjusting entries, which will be the primary focus of this video. From there, once you prepare your adjusting entries, you are now in the position to prepare your financial statements. Remember the big four financial statements: balance sheet, income statement, statement of cash flows, and statement of stockholders' equity. And then finally, when we're done with preparing the financial statements, we are then in our final process of the accounting cycle in which we close the books. And that will be a short instructional video that you will be able to download, which is called Chapter 3, Part C. It is not part of this video. So adjusting entries. Why are they needed? Because they're needed because some events occurred during the year but were not yet recorded in the daily transactions. Adjusting entries also because we're required to apply these under accrual-based accounting. Remember, that is what we call the creative writing of the accounting language. And generally, these involve our daily transactions, such as using office supplies, earning interest, expiring prepaid rent, or salaries earned by employees. There are two main types of adjusting entries that you need to be familiar with. The first bucket is called prepayments. The two flavors of prepayments are called prepaid expenses. This is where the company paid cash or had an obligation to pay cash for the purchase of an asset before an expense was incurred. There's also what we call deferred revenues. Remember, this is when we receive cash in advance, but the performance of the service is not completed. So in that case, we have an obligation or a liability to record deferred revenue for when we receive cash in advance or before we earn the revenue. So think of the prepayments as prepaid expenses and deferred revenues, which also can be thought of as prepaid revenues. And the other bucket are called accruals. We also have two flavors there. We have accrued expenses. This is where we pay cash after we incurred the expense and recorded a liability. And then we have accrued revenues, where we receive the cash after we earned the revenue and recorded an asset. And remember, if we've earned it after we received it, then that means we have some type of asset, generally cash or cash's best friend, which is accounts receivable. Do you remember that? So let's look at adjusting entry type for prepaid expenses. Let's assume on October 15th, we purchase 1,000 of supplies for cash. By the end of the year, however, only $200 of supplies remain. Think about it. We want to record the adjusting entry. This is supplies. It would be an expense. We'd want to figure out how much of the supplies have been used up by the end of the period. So the external transaction occurs on October the 15th. So that's kind of simple. We buy the supplies, an asset is increased, and another asset is decreased for the cash we paid for the supplies. So $1,000 increase, $1,000 decrease in assets, no change on the asset side. That's a totally good transaction. The adjusting entry on December 31st, and again, whenever you see December 31st, I want you to think adjusting entry, because that's generally when companies record their adjusting entries at the end of the period. So this is where we're going to think about and record what has been used up. We know that 800 of the supplies have been used up, so we'll expense supplies for $800. We'll debit in an expense. And since the asset is now only 200, we need to write the asset or decrease the asset by the same 800 so that we don't overstate the asset on our balance sheet. So the amount of the asset used up was 800. That's reported on the income statement as an expense, and we write down the value of the asset supplies because it's been used up. So we only have $200 of supplies remaining at the end of the period. Let's look at an example of deferred revenues. On November 1st, we received $3,000 from our customers for services to be provided in the future, November, December, and January. Remember, it's only November 1st, so we really won't have performed the service until the end of November, since it's ratably being earned over 3 months. So the external transaction is where the cash is received. That's received on November 1st. So cash asset is increased for $3,000, and we set up that obligation. Remember, we received the cash, but we're not going to earn it until a future period. So we'll set up a cash asset for $3,000 and a deferred revenue obligation liability for $3,000. Now, the adjusting entry on December 31st, we need to figure out how much of that revenue has been earned. Think about it. How much has been earned as of December 31st? All of November's. Use your fingers, it's okay. All of December's. So 2 months have been earned. So that means 2/3 of $3,000 is $2,000. So what we do, since it's earned, we don't have an obligation any longer, so we have to decrease the liability. So we debit the liability for $2,000. And we now can record revenue on the income statement that is earned for the same $2,000. Notice how revenues and stockholders' equity increases. Now let's look at examples for adjusting entries for the accrual types. Accrued expense flavor. So on December 31st, workers' salaries owed are $2,500, but they will not be paid until January 5th. So they're owed, which means they're incurred. It doesn't matter that they're not paid yet because under accounting, Lake Erie, right? All revenues recorded when earned and expenses are always recorded when incurred. So in this case, we go right to the adjusting entry because this is something that we would realize at the end of the period. And we would go ahead and adjust the expense for the amount of incurred expenses for salaries of $2,500. And we would go ahead up and set up a liability. Remember, payable is a liability. We'll call it salaries because it's related to salaries for the same $2,500. Now, notice that we won't pay for these salaries until the following period. So in that case, the external transaction, and remember that always involves the cash, occurs next year. So we'll debit the liability because now we're paying it. In your own personal lives, if you pay your utility bill or your cell phone bill or your car payment, you don't have an obligation any longer. So neither would the company. So we'll go ahead and decrease the liability for $2,500 and also decrease the cash asset. See how easy adjusting entries are? And next, the adjusting entries for accrued revenue. On September 1st, the company lends $10,000 to an employee due in 1 year with a 12% interest receivable. In this case, we have the adjusting entry because we're going to have some revenue to earn on this note. The employee signed a note. That means they're going to pay the note back with interest. So there'll be some interest earned. So in this case, you need to figure out how much interest is earned. So we're going to use this old formula, which is called the principal times the rate times the time. I want you to think of that as P times R times T. Think of it as PRT, P-R-T, PRT, principal times rate times time. I know that sounds weird, but maybe it will help you remember it. The principal is $10,000. The annual rate is 12%. And the time is always a fraction where the denominator is always 12 and the numerator is the number of months from the date that you took out the note or that it was issued. In this case, September 1st. So September, October, November, December. There's 4 months of interest. That would come out to $400. You'd set up a receivable. We'll call it interest receivable since it's for interest. And revenue's been earned, and we'll call it interest revenue because it's interest revenue. Now, the external transaction, which occurs next year, is when what happens? The cash. The cash for the interest will be paid because it was a one-year note. We're going to ignore the principal for now, since we're learning the basics of these types of transactions. So just assume that all of the interest, what would be 1 year's worth of interest be on the 10,000 if you go back above, right? It would be the 10,000 times 12% or 1,200. It just turns out that 400 of it was earned in the prior year for the 4 months, and the remainder is earned in the following year. We will then clean up our balance sheet. We no longer need this interest receivable because we received the cash. So we'll credit interest receivable from the adjusting entry on December 31st. And since we have not recorded all of the revenue, we only recorded 400 last year, we still have another 800 of revenue to record. So in this case, this will complete the transaction and balance it out into its entirety. And all companies must begin the year with what we call a trial balance. The beginning of year balances represent all of what we call the permanent accounts. Permanent accounts are what you're going to think of as your PALs. P stands for permanent. PALs, ALS, are your assets, liabilities, and stockholders' equity accounts. Please go down here and notice that all of the beginning of year balances are your PALs. They stick around for a long time. All of the accounts that don't have balances on the beginning of your balance sheet are known as the temporary accounts, which I also call the TRED. T for temporary, R for revenues, E for expenses, D for dividends. I'll offer a short video on this later, a very short one actually. So really you need to think of the permanent accounts as your PALs because they stick around for a long time. We never zero them out. They're not closed out, which will come up in the third video in chapter 3. And our TRED accounts, our temporary accounts, our revenues, our expenses, and our dividend accounts are always zeroed out at the end of the period. And so at the beginning of the period, we open up with only our PALs because they stick around for a long time. Well, that concludes our video of adjusting entries. Have a great afternoon.